Do you want to make profits like this almost every single time you click the buy or sell button? I'm sure your answer is yes, because who doesn't? So what's the secret, you might be asking? Well, it all comes down to one indicator that can read the chart and predict the future market price with a really high accuracy. And in this video, I will give you a full tutorial on how to use this tool correctly so that you can make consistent profits from absolutely any market. Okay, without wasting any time, let's get straight into it. So we have currently opened the chart of Ethereum USDT on the 5-minute time frame. This indicator shows great results on all time frames, including a 1-minute chart. So in order to install it, you need to head over to the indicator section and then search for the Echo forecast. It's going to be this script right here. The creator is Lux Algo. This indicator uses a simple time series forecasting method derived from the similarity between recent prices and similar or dissimilar historical prices. This method originally assumes that future prices can be estimated from a historical series of observations that are most similar to the most recent price variations. This similarity is quantified using the correlation coefficient. Such an assumption can prove to be relatively effective with the forecasting of a periodic time series. This indicator consists of 4 parts. First part is the evaluation window, which consists of the grey and the green backgrounds. The second part is the forecast window. Next, we have the most similar segment within the total evaluation window. This area has a green background. And finally, we have the prediction or the forecast. Based on this line, we're going to be determining where the price action is going to go, up or down. Let me now show you how it works on the practice. So here we see the indicator found a very similar price pattern to the one that you can see in a forecast window. Notice in the orange window the price action is making higher highs and higher lows. And in a green window we have a very similar pattern. So based on this information, the indicator is predicting that the price will move higher. As we can see, the prediction was correct. And if you had entered the trade somewhere here, you would have made a massive profit. Here's another great example. So in the orange window we have the price making a sharp move to the upside, followed by a pullback. The same thing happens in the most similar segment of the evaluation window. We see we have a sharp move to the upside, and then the price action retracts and makes a pullback. So based on this we have a prediction. And it was quite accurate as well. However, there is one massive problem with this tool. You see, these predictions can be quite accurate, but you cannot solely rely on this indicator. Also, you don't quite know when to buy and when to sell. So in order to solve this, we need to add one more indicator to the chart. And this indicator is called CM Price Action Bars. Is this one by Chris Moody. So before we can actually use it, we need to click on its settings and enable some of the options. So the purple candlesticks you can see on a chart are bearish candlesticks that have an upper wick and their closing price is the same as their lowest price. Blue candlesticks on the other hand are bullish candlesticks that have a lower wick and their closing price is the same as their highest price. Based on this indicator, we're going to be placing buy and sell orders. For example, when the indicator finds a bullish candlestick that has no upper wick, and the forecast is telling us that the price action is more likely to continue to move upwards, this is going to be a signal to buy. Even though the strategy is great, I believe we can make it even better. So in order to do that, we need to add a very simple trend filter which is called the exponential moving average. Make sure you set its length at 200. So the general rule is, if the price action is moving above the EMA, we're only going to be looking to buy. If the price action is moving below the EMA, we're only going to be looking to sell. Okay, now let's understand the exact rules for entering a long trade. First, a blue bar is printed on a chart, and its closing price is higher than the peak of the previous bar. If the closing price does not exceed the high of the previous candle, the signal becomes invalid. Rule number 2, the candlestick must be fully above the exponential moving average. This means that the wick nor the body is touching the line. Rule number 3, the Echo forecast indicator must predict an uptrend. So for this signal to be valid, you need to take a measurement tool, set a buy order at the open of the next candle, and a take profit at 2 times the risk. And now pay close attention to this blue forecasting line. For a buy signal to be valid, the line must reach the take profit target first before it reaches the stop loss. If, for example, the line does not reach the take profit, you do not enter the trade. If it reaches the stop loss first and then it moves up, you also skip the trade. In this example, we see the line perfectly triggers at take profit. By the way, when the price action reaches a 1-to-1 risk reward, your stop loss is going to be moved to the break even. Here's one more long example. We see the price is moving above the exponential moving average, a strong bullish candlestick has been identified, and its closing price is greater than the peak of the previous candlestick. We also seen that the blue line is predicting a strong upward momentum, so we take a measurement tool, place our stop loss slightly below the recent swing low, and the take profit at 2 times the risk. The prediction looks good. We are expecting the take profit target to be reached before the price reaches our stop loss. And here we go, the prediction was accurate. Here we had another long signal, and all the conditions were met as well. As you can see, this indicator works like magic. Okay, now let's learn the sell entries. So first, the candlestick must be fully closed below the EMA. Second, a purple bar must be printed on a chart, and its closing price must be below the low of the previous candlestick. A third condition is to have the blue line predicting a downtrend. Once these rules are met, you're going to take a measurement tool and set a sell order at the open price of the next candlestick, then place your stop loss slightly above the recent swing high, and the take profit at 2 times the risk. And now look at the blue line. If the line reaches your take profit target first, then you can go ahead and open a sell position. If the line predicts that the stop loss will get triggered, then you should skip the signal. And again, when the price action reaches a risk reward of 1-to-1, your stop loss will be placed at the price you entered the trade. Also take a look at how well this indicator reacts to a ranging market. Notice when the indicator spots a sideways momentum in both of these windows, the prediction will usually be a ranging market. A size of the window can also indicate a consolidation stage in the market. We see they become narrow, and this is an ultimate indication that we cannot be taking trades during this time. Okay, now let me show you the backtesting results after taking 100 trades with this strategy. The win ratio is 79%, which is crazy high for a 5-minute scalping strategy. The gain on the account is almost 790%. These numbers are insane considering the fact that I was risking 2% of my account per trade. The profit factor is 5.27, and the maximum drawdown does not exceed 5%. So yeah, the strategy is indeed working. All you need to do is to forward test it with paper money first.